Rob Subbaraman, who is head of global macro research at Nomura, now joining in on the show. Thanks much for taking time out, Rob. It's an interesting report that you've come out with. And, the first line talks about how the depth and breadth as well as the length does remain very uncertain. But I think the question on everyone's mind is that given the world economy's prospects due to coronavirus, could this trigger some sort of a global recession?
It's, as you said in that first line, it's still extremely uncertain. There's good and bad cases at the moment. The positive signs are that the coronavirus in China seems to be easing off. The number of daily infections has fallen quite significantly. So it looks like in China, the draconian policies are starting to work. On the other hand, those draconian policies have led to a massive supply disruptions. And so China GDP growth, we think, is going to be at least halving between Q4 and Q1 this current quarter. So it's looking like this quarter will be 3% year on year. And to put that into perspective, if you're trying to look at, for instance, how the US calculate GDP growth on a quarter-on-quarter annualized basis, it's more like minus 6% quarter-on-quarter annualized for China this quarter. So China will be in quite deep recession. The damage has already been done. The good news is the virus looks like it's easing off. The other concern is outside China. There's been a number of clusters from South Korea in particular, but also in Japan, in Italy, in Iran, and spreading to more countries. So the risk is rising that this could become a global pandemic, and that a lot of the kind of public fear factors that were playing out in China, and as a result, the tough government controls, could start to be replicated in other countries. If that starts to happen, what you talked about in terms of a global recession could be on the cards.
Recession means more loose monetary policy. That means more liquidity. That means more money moving into perhaps performing assets like gold, US equities.
Well, it's not clear, right, at this stage whether the major central banks are going to cut interest rates. At this stage, it's still quite possible that this coronavirus shock is going to be V-shaped. It's going to lead to a very bad Q1, but then we could get the virus easing off, as it has in China already. And then you get pent-up demand production coming through and a rebound. In that case, it's quite possible that the Fed, the ECB, look through the temporary damage. I would say at this stage, it's looking more like a fiscal response, particularly trying to help, obviously, the health sectors. But in addition, there could be efforts to help, particularly small companies that are struggling with lost activity, so cash flow problems. You could see, for instance, some tax rebates or subsidies for small companies. That's what China has very much focused on. They've cut rates a little bit, but it's been much more a fiscal response at this stage. So I think it's too early, really, to talk about big interest rate cuts outside Asia. Even in Asia, Korea today, the market was expecting Bank of Korea to cut rates. They chose not to.
How would you assess the data which is coming from the Chinese government? I'm saying this in the right spirit, but I'm also aware of the fact that sometimes data does not tell you, Chinese data does not tell you the true story.
So I think you have to, the first principle is to realize that this has been a devastating demand and supply shock simultaneously, right? Demand, I mean fear factor, people are not spending. Supply, I mean all the government controls stopping people going back to work, severing transportation links. So it is going to have a huge impact. And I think people maybe are underappreciating when actually activity stalls, the impact on GDP growth is going to be huge. So this Saturday is going to be very interesting. We're getting the manufacturing PMI data and services. And if manufacturing was 50 in January, we reckon it's going to drop to probably around 35 or so in February. So we're talking about, a 15-point drop. Services could be a similar scale drop. So I think that's going to be the first real indication of how much this is really hurting China's economy. As I said, we expect China's growth, the way it's reported year on year, to be around 3% in Q1 versus 6% in Q4. The risk is it could be even lower than that. And the point for other countries, India and other economies around the world, China is much bigger than it was during SARS. It's about 4 times bigger as a share of world GDP. And so there's going to be sizable spillover effects on other economies. And as I mentioned earlier, if this turns out to be a global pandemic, in addition to spillover effects from China on other countries, these other countries have got their own direct effects from the coronavirus. So we're still we're still not out of the woods by any means.
So within the emerging market basket, and I, of course, ask from an India-specific point of view, how vulnerable do you think the economy is or the outlook is currently for us on the back of these developments on coronavirus?
So we've done quite a bit of work at Nomura at looking at scorecards of which countries are most likely to be infected or face contagion from this virus. Who could be next to see a big increase in coronavirus cases, and also the economic impact. And on both those scores, what we find is that Asia is by far the region most exposed to contracting the virus, but also the economic impact. But interestingly, within Asia, India is the least exposed. In part, it's because India does not have as strong links with China in terms of visitor arrivals and so forth as some of these other Asian countries, but also the economic spillovers from China onto India are not as severe. So in a way, there's been a lot of concern, I think, in past years that India has been slow to get involved in Asia's very sophisticated supply chain for production across countries where China is the epicenter. In a way, that's now to India's favor in that it hasn't been as involved in this supply chain. It's not going to be affected as much as China really faces much weaker growth and less production and less exports and imports in the coming months.
Which asset class, to your mind, has overreacted in relation to the coronavirus? Is it crude, which has gone down, or is it gold, which has gone up?
I don't think there's been an overreaction, really, to be honest. I think the moves have been fair. I would say at this point, maybe equities still haven't reacted enough. If I look where they are compared to what's happened in the say Treasury markets. So I think it's fair. And you raise a very good point around for India. The drop in oil prices is a bigger relief for India than it is for most other economies. India is very dependent on oil, as you know. The challenge I see for India, though, is going into this coronavirus, India's domestic economy was already struggling, particularly because of all the financial sector problems. And when you have financial sector problems, that's the life and blood of an economy. It's very hard when you have crises there to get growth picking up again. And that's what India's been struggling with. And now there's been this global shock. So, from our perspective, we already thought at Nomura that the recovery in India was going to be very long. It's going to be very drawn out. We didn't expect India to get back to around 5% growth or so until the second quarter of this calendar year, so Q2 2020. The risk, I would say, for India is that could be pushed out even further into Q3, until India gets back to 5% if this coronavirus keeps spreading further in other countries outside China. So we do think, for India, there is going to have to be more policy responses. And given fiscal is constrained, we do think RBI is going to have to cut rates further.
Thanks very much for giving us your assessment of the coronavirus impact on the global economy.